go along, just pop them into the chat box. Name is Dr. George Nyabaza. Sam, thank you for hosting. So what I thought I would do a couple of weeks ago, I had the honor of presenting to you just immediate effects using the daily chart of that war that the world is experiencing, directly watching, being impacted, oil prices, things changing, etc. And at that point, one of the things I said distinctly a couple of weeks ago was that there was nothing that would have said to you, if you just opened the charts and looked at it, there's nothing that would have said to you, hang on, something is happening in the world. So fortunate enough to be able to come back to you again, and let's have a look at as many markets as we can, because I know a lot of traders are looking at virtually at everything. So we'll just go down the list and see if we can get to most of them. So we are in March. This is March, and we are coming into, well, virtually the last week. There's a couple more days the following week. Last 7 trading days of the month in which the war erupted right on that weekend, last weekend of the month. And this gap here, and most markets will have some sort of a gap, and we'll see as you go along, as a reaction to the news and the announcement of the wars, etc. Then we went, this is gold now, went into a trading range. The market is going sideways. So I'm looking at things purely from a price action perspective. That candle defined the market. And once we had that, there was an option, or not an option. Bulls could either accelerate up, and after processing, digesting, deciding if they were surprised at all with what took place. Some already had backed it in. And bears, of course, had the opportunity to break out below. So we went sideways, and then this is last 3 days of last week. Bears breaking out of the trading range. And as price action traders, or at least as I'm sharing with you, depending on how you trade, but as price action traders, whenever we see a trading range of sorts, we always consider a measured move. 2 prices, high, low, creating a measured move. Measured move is simply a hidden level that unless you put in, you're not going to see, right? So that's taking place. Anything else on the left that could be of interest to our friends, the bears? There is that, which was the low of February. So bears selling here using price action would have said, hang on, we can take that. I can put my stop wherever I want to put my stop at. My first profit target level is a measured move. So you get that kind of reaction is profit taken from bears who are using this kind of structures to trade. And of course, bulls, after this huge rally that excited everyone, gold is going to keep going on until it gets to whatever, 10,000. And then with this huge collapse here, these bulls are probably saying, well, hang on, let's try and defend this level. Okay, because we're pretty strong here. And we bought here and, couldn't get to that high, but that's a level that the bulls are trading, are defending. Of course, the bears are seeing that. And if the bears are strong enough, which of course the bears want to be, and if they do what they did here and start to break out here, depending Monday, Tuesday, if the bears are strong, what are the bears going to look at? They want to look at now the larger trading range, that high to that low, and say, well, there's the next target, right, for the bulls to defend. You could even use that if you wanted. If bulls fail to contain the bears here, the bears want to take profits here. So there could be a lot more selling. Will it just go down like that? Who knows? We might get a trend, which means we will get market reaching a new low, pulling back, and then do lower highs, etc. So that's kind of my view on gold. Now, if the bulls are strong, who did this and who stopped the bears here? So We're at that low. We're at a higher low. If the bulls are strong, what do you think is going to happen, guys? Well, we're going to have bulls coming back, right? And we might just end up in a broader trading range. So you got to be considering based on whatever signals you trade, what's going to happen if bears break out or a bull's going to create this kind of price action and we end up in a range or accelerate up. So is this the effect of the war? Is this just normal price action? I mean, immediately after the war, nothing except the gap up and the bears coming back, sideways price action. Just ordinary price action that we can interpret. Hey, Thiam, trust your voices. Okay, let's pop up another one, UK 100. Quite interesting, isn't it? We had 3 days of selling on gold. We have 3 days of selling again on, again, we have 3 days of selling also on the UK 100. Now, just based on what I kind of shared, if you look at it, can your mind create a pattern that you can say, well, okay, I think that's what I'm beginning to see here. We went sideways here, and of course, whenever you have any kind of a trading range, just kind of see if you can contain it anywhere you're there. You know, that was the low of the trading range. Kind of sideways here, you know, you could say, well, that was a key low within there. That's perfectly fine. You could say that, you know, bears failing to break out beneath that. But I prefer to be a little bit more conservative, give the things room. So this is also trading range price action. And if we have a trading range, guys, an easy thing for you to pop in is a measured move. So the target as far as the bears on UK 100 would be to get there. Okay. Now, anything to the left, we have broken out beneath the low of February. There's some levels here that they could be looking at. So what is likely to happen? Let's see what happens tomorrow. And are the bears going to be strong enough to just keep selling? That's a good candle for the bears, right? I mean, big bodies, small tails. Are the bears going to just follow through with more selling on Monday? If they do that, that's fantastic. Now, if you trade in the daily chart, what are you going to do? You know, if you just sell here, where do you put your stop? From a price action perspective, you're just going to see where the breakout is beginning. So your stop still has to be way up here. And you can't put your stop here because the bulls can just come back, try and test the resolve of the bears, and you get stopped out. And the next day it starts to accelerate and say, oh my goodness, why did I use a tight stop? If you're going to sell, the stop is going to be above here, right? It's above the trading range, but where we're looking out is the breakout. But that is a key level. It's a hidden level. You can't see it, but you got to put it in. Shouldn't stop you from trading, but you got to see it's there. So if you're going to sell, fantastic, right? But you cannot ignore the level because that means, or the level means that you can have bulls coming in. So if you're going to sell and you put your stop here because you're saying, I think the bears are going to break out beneath this level and just keep decelerating the prices to zero. If you're going to do that, then you sell and you hold your stop until you get confirmation. You know, we might get a bear candle, might get the bulls coming back. We don't know what you're going to get. And you know, if we do get the resumption, then you can tighten your stop. So when I talk to traders, most traders, that is such a horrible thing to say. Most traders, there's nothing like most traders. When I talk to traders, there's two things that comes across quite often. Traders take a trade. They can see whatever the strategy they're trading, they execute the trade. Let's say pristinely, right? They do everything right. Now they're trading the daily chart. There's two things that happens. Either they take the trade and they say, okay, I'm just going to let it run. I know the rules. I'm going to walk away. I'm not even going to be bothered. Although, you know, inside when I'm having coffee and having lunch, I'm like, oh my goodness, I wonder if my trade is working. That's perfectly okay, right? You know, when you walk away from your charts, we are not we are not robots or some you know, the science fiction beings that can completely shut off things. No, you're just gonna pay. You know, it's there, but do not. Then traders don't do it; they leave it. they know because the signal is a daily chart. I have to wait for the daily candle to close. So when the daily closes, they come back and say, oh, that's what happened. Now, what do my rules say about trailing the stop? Other traders, when they execute a trade, then they start worrying about it. They forget about the rules. They're in the trade today. So they've been triggered in, okay, and they're expecting the bears to keep carrying on. Maybe they didn't have that level in there, or maybe it didn't show up on their charts for whatever reason. And then the market starts to do that during the day, like that. And they may come and it's down here. It's like, fantastic, got it. Maybe it's just short of my target, whatever it may be. Or they come back and it's doing that, and then they start to panic, and then they close their trades. Well, that's not the thing to do, right? If you have these levels and the market is doing that, it's just trying to break out beneath that. The bulls might even come back. Doesn't mean if you have assumed bear trend is strong, that tomorrow it's not going to do this. Okay. So then you only adjust your stop when the day has closed. The key point is just try and put some of these things, measured moves, so that when things get there, you're not surprised. You might have some level. I mean, there's levels that other systems use, right? You might get some level there already and you've got the alert, but if you don't have it, just plonk it in. So bearish on the UK 100. Here's another thing. The trend started there. We call that the first leg. And the pullback is there. So that was the first leg. That is a pullback. And guess where the second leg is from a price action perspective? The second leg from a price action perspective, we expect to end there. So if you trade in purely price action and you're looking at this and you decide to take the trade, you've got to expect some form of a reaction here. So if you're taking this and thinking the bears are strong, going to go far, then just hold on to your trade, because from a price action perspective, that's two hidden levels of support that are pretty strong. Let's look at a currency. We're just going down the list. I didn't order them in any particular way. Now, you look at that and you're saying, well, this is what's happening in March. What is likely to happen? It's pretty confusing, right? When you have a look at it. Well, if it's pretty confusing, just look and say, is there anything on the chart that's pretty distinct for me? In the month itself, maybe we're talking about trading ranges. Okay, there's an upward slope in trading range, which means the market is going up. Throughout March, the market has been going up. By the way, this is a 10 EMA, which we use. With the asset valuation zones of trading, which is my way of trading, AVZ of trading, we use 10 EMA as an indicator of trend strength. As long as the market is going up and it's above 10 EMA strong. So sideways, it's ranging. It's not like big bull breakout, pullback, etc., but it is going up. It is above the 10 EMA. But then we have this candle on Thursday, and it's like, wow, look at that. The bears, for whatever reason, we're not looking at what drove it, etc., but let's just look at the price action. The bears were strong enough to break the strength of the trend. So if you're looking at that on Thursday, you've said, well, bears were so strong. I mean, this is absolutely fantastic. Maybe it's bears that had created this or that are defending that level. And they're saying, well, this asset value cannot go any higher. But then why did we fail? Why did we fail? Ask the bears. Why didn't we do this? Why didn't we have followed through? After breaking the 10 EMA, why didn't we have followed through? So even if bears wanted to sell here, there would have been bears saying, okay, let's try and sell here. We can put our stop here or use a wider stop. By the way, let's talk about that quickly. Just check it in. You can put your stop above here. That is perfectly fine. Technical level, it's a key level, put it there. Or you can say, if I get triggered here, I don't like my stop there, and I can see bulls are strong, bears are strong, bears defended, but, there might just be a little bit more push up before the bears decide, okay, let's put as much force as we can, and the bulls give up. So you could always have a look at that and say, well, I'm going to put it the other way around, a stop equal to the height of the signal. So a measured move stop. You can put your stop there, which is perfectly fine, because you say, well, if I get triggered here, if the bulls come back, that thing about stop again, I'm not going to panic, right? I'll manage my stop, unless there's a huge bull candle that stops me out. Anything can happen. Who knows what can happen? But I'm going to put my stop there. I'm going to sell here, and hopefully, if the bears test here, I'll make my money. So you might be thinking, if I get triggered in here, my stop is up here. If I just leave it and come back, after a few days, whatever, I might make my 1 times risk, whatever the case may be. But then we don't get triggered in. So that's a problem, right? We don't get triggered in. So if we go back, remember the gold example that we had? I'm not going to go there for time. You can rewind if you want. We have a trading range that's been formed for us. We have a high, we have a big bear candle, and the bulls came back. So we are within the range of this bear candle, which was, if you look back to the middle of February, that's the biggest bear candle we've had. And it reversed 2, 4, 5, 6, 7 days almost of trade. So we are kind of contained within that. So as far as yen is concerned, in terms of decision making, makes your decision making pretty easy, right? You don't want to do anything within here at all, right? Because the bulls might come tomorrow, get here, fail, bears come back, and we might just end up in a range. So what you want to do is just wait to see, if you get at some point maybe a breakout by the bears or a breakout by the bulls, then you can make decisions. Okay, do I sell here, put my stop above here? Do I buy here, put my stop here? Knowing, of course, that now there is this invisible level, hidden level of support created by that. Let's put it here just for ease. Okay. I'm going to remove these stop levels just for clarity. Okay, so there is that level which is within here. And you also know, well, if we do get, well, I'm saying you also know, let's look at it. Why would this be important? Why would the bears want to go for this? Well, there's something else, guys. There is a low of the month so far. So if the bears are strong enough to break out beneath, the measured move is down here, the hidden level of support. And that is very key, because if they can get here, they have broken through the low of the month, which was that first candle of the month, the day after the war erupted, strong for the bulls, and the bulls, pushed the market up. I just couldn't get above this level. So the bears have a keen desire, if you like, to break out beneath that level and then take that out and get to the level. And if they do that, they're going to take that out. But of course, the bulls don't want that. So the bulls may want to break out above that. And if the bulls do that, their first port of call in terms of profit taking would be a measured move. So for decision making, you can say, oh, I like what the bulls have done. Maybe the bulls have now completely taken out that level, and they're strong. This was just a pullback, profit taking. I'm going to buy, I'm going to put my stop here, but I can see that level and I can manage my trades, maybe to just go sideways. So I'm not going to rush to trail my stop, because if the bulls are strong enough, they may get to that and then just keep accelerating and maybe get to an even bigger measured move. Hang Seng 50. Let's have a look at Hang Seng 50. Okay, I'm just, all right, no questions. That's fantastic. Let me make sure I don't miss out anything. Trading range. Okay. If you just start to put these things in, if you get just create a clean chart. Okay, when I say clean, all I've got is EMAs, just for you to train yourself in terms of price action, having a look at it. With a trading range there, now, It's not like I engineered, right? If you had done that in February, I said, well, if the bears break out, that's a measured move. Look how precise the measured moves are. We got to the measured move. Okay, so if that had been, let's say, a decent enough bear trend candle as a signal without a big tail, and you wanted to sell it, that's your target. But even if you, sorry guys, excuse me half a second. My apologies, folks. But even if you wanted to sell that, let's just assume you're gonna sell it. You've seen the measured move. You're gonna go for it. Put a stop up here. You know, when you get to that level, you should be taking your profits because of the hidden levels of support. Now, we now have, as far as Hang Seng is concerned, a trading range. Now, why am I just saying we have a trading range? Because if you're trading this on the daily, just by looking at it, would you say, oh my goodness, I missed a move here. I missed a bull move or I missed a bear move. You wouldn't say that because even if you go candle by candle, it's just overlapping sideways. There is nothing at all that you can say, man, I should have jumped in there or I should have jumped in there. We have another trading range. I mean, unlike what we saw on gold or UK 100, when we have three bear trend candles, we are in a trading range. However, look at how this might set up for us. So February showed us trading range, daily chart, nothing for you. It's like, oh man, boring. March, so far in a trading range, but it's the same structure, right? Same kind of thinking, as far as price action is concerned, there is a measured move. So if tomorrow, depending how you trade, depending how your strategy is set up. So if your strategy says you're going to sell beneath the bear candle, okay, if that is your strategy, you got to be looking at that. If your strategy says wait to see the breakout and get a bear candle, okay, you see, like we got here, but let's say we get, I'm saying let's see because that's where I would look at it. I would like to see, a bear candle that doesn't have a big tail, small tail, showing me the bears are strong. If you're going to sell that, your stop, of course, why would your stop be there? Now, here's something to bear in mind. When you have these trading ranges and measured moves, you got to think of, or when you have any trading range, forget about measure moves. Whenever I look at the chart and say, well, we're going sideways, it's that's what you can see, right? Even if you're not informed in terms of using measured moves, you've got to think of a trading range as a big magnet. Okay, there are magnetic forces there that have created the trading range that are forcing the market to stay in that range. So, reason you put your stop here is that you might just get a breakout unless the bears are very strong. The magnet is just going to pull them back. They might just come back in here. So if you put your stop anywhere within the range, might get stopped out and the bears come back again and give you three beautiful breakout trend. Can also test this level and you're disappointed because you had a tight stop. Right? Where you put your stop when you're trading out of a trading range is different where you put your stop when you're in a strong trend. That's, I guess that's probably so. Be very careful. These measured moves simply say I'm using my own words here, but I hope it to make sense. The magnetic force of the trading range extends to this level. The strongest part of it where the bears have to be very strong to keep accelerating down and we keep going with them. And the bulls are trying to make it fail. The bulls are going to keep on buying as the bears are selling. Okay, the bulls will keep on buying. Someone has to take the other side, but they're overwhelmed, hence the bears in control. But when they get here, they know bears might take profits. And if the bulls keep on buying, we might get what we got here. Got to the measured move and just kept on going sideways. So Hang Seng 50, dependent on the way that you trade, either taking that trade tomorrow, putting a stop here, or you're waiting for follow through confirmation to get bears, and then you get to sell. How are we doing for time? Good. We can look at pound and then hopefully look at US 30. Is pound. Would you be saying, man, what a beautiful trend or not? I don't think you'd be saying that. Now, look at this here. At some point, that was probably defining. You say, well, guys, we have a trading range from that first candle to that. Tried to break out, failed. Tried to break out. The bears would have thought, okay, this is fantastic, good, follow through candle. If they trigger me here, I'm gonna sell, put my stop above the trading range, which should be above here. But nothing happened. Okay. And instead, all we ended up getting on the daily chart on the pound. And if you ever look at, if you're doing any kind of preparation today, you follow these principles, put up any chart and just on the daily, just quickly draw some lines for yourself and see, and you begin to get fascinated by what's going on here in terms of the insights that you get. So the bears haven't failed here. The bulls haven't failed here. We just have a bigger trading range, right? So on the daily chart, are you going to buy or sell? I have absolutely no idea. Why don't I have an idea? Because I'm in a trading range. All I know is that if the bulls are strong, they're going to break out forcefully and break out above. They want to break out to get to the measured move above the high of February. And if they're stronger still, then they want to take out the high of the year. But if I'm trading this on a daily chart, again, I'm going to say, well, if the bears are strong, we already have a new low of the year. Okay, because let's just move my zoom to be certain. Okay, there was the low of Jan. So we got a new low on this currency pair. And now the measured move will be down here. But you're going to have to wait, right, on the daily chart. Let's have a look at US 30, and then we will be done. Fascinating. One of the key proponents in the war, you would have thought, well, something dramatic is going to happen with the US candles. US 30, right? Top 30 companies, etc. But you have to look at it with the trading range in January. If wars were started to make sure your stocks go up, well, this is not taking place, is it? And then the bulls had an opportunity to break out here, and we failed, and we ended up in a range. There is a low of the month, ended up in a range. And then, absolutely nothing dramatic. We spoke about it in my last presentation on that breakout of the war. And the bears are strong. Why are the bears strong, guys? Because we are staying beneath the 10 EMA. We saw that with one of the other markets earlier on when we were staying above the 10 EMA. Trading range price action. Why am I saying that? If you look at this here, just visually, okay, it's not a strong bear trend in terms of big breakout, pull back, I'm going to jump in for leg two, etc. It's like a trading range that's sloping downwards. If you're able to visualize it, it could just be going sideways, right? So we are in a trading range. Now, if we are in a trading range, one of two things can happen. Either the bears are going to keep on doing what they're doing, respecting the 10 EMA. Okay. We don't know how long this range can carry on. The market is going down, but making it very difficult. If you say, well, it's going down, Dr. George, I'm going to sell. Oh my goodness, you need to have strong emotional fortitude, because if you sell anyway, there's all this trading range price action. So you're going to be in profit, in loss, in profit, in loss. And after a long time, you're like, okay, I'm in profits. Trading range behavior is probably not necessary, right? At some point, we might get a breakout beneath the channel. When you see that breakout beneath the channel, do not trade it, because it's still the whole principle of the measured move. It's still the whole principle of the measured move. Okay. You sell it and say, oh, the bears are so strong, they're breaking out beneath the trading range. I'm going to go for it. You sell it, and then it comes back. You're like, but what happened? They were so strong. Well, all you've done is just forgotten about the magnetic forces in a trading range. The fact that is sloping down does not change what is taking place. So we have, I hope that's provided some insight into you. There's some markets, I reckon just go through your markets, look at your market watch list. There are some that are showing trends, 3 bear trend candles, trend potential. You got to watch out for the measured moves, or wait for the pullbacks, or put a stop in the right place. Don't use tight stops. All right, guys, I hope you found that useful. Purely price action. Name is Dr. George, and we will catch up again. Let's have a look. All right, guys, sincerely appreciate it. Sam, thank you very much for hosting. Thank you for all the waves and all the headshakes.